Fresh off another Fed cut of the interest rate, we're getting reaction from our real estate expert, Rick Sadle with Keller Williams Realty and SadleRealEstate.com. Rick, good morning to you.
Hey, good morning.
Oh, we do this dance, when the Fed makes moves. So let's start by recapping their decision and then compare that to, say, a 30-year fixed mortgage rate.
Yeah, well, as we all know, and we've talked about ad nauseum at this point, in an effort to control inflation, the Fed had raised the overnight lending rate to the highest it's been in a while, right? Then in September, they cut that rate for the first time in a couple of years. In fact, they cut it by a full half point. Now, mortgage rates at that point had kind of anticipated that rate cut and had already dropped, right? Since then, they've gone up. So they're trending right now above 6.5% for a 30-year fixed rate. Now, at this last meeting a few days ago, the Fed cut the rates again by another quarter point. Time will tell what the long-term effects will be. Likely they'll trend down. But what we do know is overall they're down from 7.5% same time last year to right around 6.5% or a little above this year. So they're going in the right direction.
Okay, what's the Fed's attitude right now about the U.S. economy and what potential home buyers or sellers, what do you think they should take from that?
Yeah, well, the Fed seems to think that inflation is headed where it's supposed to be, or at least it's going in the right direction, right? Along with that, they feel like the labor market might be softening just a bit, and they're trying to achieve that quote unquote soft landing, right? Where inflation is under control, but they don't trigger a recession and also keep our labor market strong. So overall, they're trying to keep our economy in a strong position, but not too strong. Now, home sellers and buyers should be hopeful, right? What they seem to be achieving is a housing market that will remain strong, where buyers get more choices, but sellers won't see massive price declines. And that seems to be happening.
For non-experts like me, I see these interest rate cuts, which theoretically put more money into the economy and pocketbooks of consumers. Does that mean people should have a little bit more money for things like down payments on the buy side and, home improvements or something on the sell side?
I mean, yeah, definitely, right. The Fed rate cuts, first and foremost, affect primarily consumer debt, things like credit card rates and auto loans, right? And those are pretty high right now. So as those come down, as the Fed cuts the rates, there should be more money in people's pockets for all those things. Also, as far as mortgage rates, as those trend down, that should make houses more affordable in general.
So big picture this thing for us, Rick, here, mortgage rates, not interest rates. So mortgage rates, again, as we get your prediction, won't hold you to it, but want your perspective. The numbers my people might expect to see when applying for a home loan before the holidays and maybe into January.
Well, I can say whatever I want and people will forget, right? No, so I do suspect the Fed is going to do another, federal funds rate cut by the end of the year. And that in turn should affect mortgage rates in the downward sense. So my guess is we'll see rates between 6 and 6.5 by the end of the year, and likely in the fives next year. So fingers crossed.